Hi everyone, good morning.
Good morning, sir.
Good morning Archana. Good morning Alex. Good morning Jeju, Marina, Ninju. Good morning Prasamsa, Ratna, Salina. Good morning everyone.
Morning, sir.
Good morning Alex. Doing good Alex, what about you? So I just completed your multiple choice question, and the news is that it will be conducted by management, and you'll be given half an hour for multiple choice question. There are 20 different questions. Each question weighs about 5 marks. So if you want to score full marks, then you have to go through slides, right? Many of the questions are inculcated from slides, which I have already shared in iLearn. So please make sure that you score full marks, total 100, okay, in multiple choice. Many questions are really easy as well, but some of them are really tricky. One or two are the toughest ones, and I'm expecting few of you to solve those questions as well. So best of luck for your MCQ. And please note that MCQ will be conducted only for chapter learning outcome 4, risk and return. So what you can do is you can go back home and go through slides. I would it will not take much time, and you can solve questions in the exam, okay? And separate time will be declared by management for you to go through that test, okay? So let me know if you want to know anything. So again, good morning everyone. Let me share you one news of Forbes magazine about financial statement of Facebook. Okay, so this is the news. Facebook post record 29 billion in second quarter revenue, blowing past Wall Street expectations. Right, so there are podcasts as well if you want to further understand it. Okay, so Facebook reports record second quarter results Wednesday afternoon that shattered analyst expectations. Now, by the term second quarter, what does it mean? For the first quarter, I think January, February, March is first quarter. April, May, June. Up to June is second quarter for companies outside Nepal, right? So within July, they have already published their financial report. Okay, since it is a public company, of course, its financial statements will be public. Amid concerns that company growth is no longer up to par with small rivals, Twitter and Snap. Okay, so let me repeat. But shares of tech giant fell immediately after the announcement amid concerns the company's growth is no longer up to smaller rivals Twitter and Snap following their staggering results last week. So now the popularity of Twitter and Snapchat is increasing, but out of which the growth of Facebook is now constant. So it's not growing as it used to, right? Its growth G is constant, okay? Now, because of which its share price is decreasing. Key facts: shortly after market closing bell, Menlo Park Calf-based Facebook reported second quarter revenue of 29 billion. Although it was rise, but growth was not enough to compensate for expectation of investors. Up 56% from the same period last year, and even beating out average analyst expectation, calling to 27.8 billion. Analysts were calling that yes, Facebook is going to diminish in terms of revenue. It is not going to increase beyond 27.8, but yes, it increased up to 29. But those there are new market players like Twitter and Snapchats, and their growth was huge. So there is a correlation between these stocks. Like as I think correlation is negative. Okay, so as you can see that from the news, when stock of Snapchat went up, when the stock of Twitter went up, and their profit and revenue rose with huge growth in second quarter. Then Facebook's growth was not enough to make sure that the investors of Facebook would remain in Facebook. They definitely shifted their portfolio towards Snapchat and Twitter or any other growth or alternative companies. So definitely you can see that correlation between Snapchat and Twitter share with Facebook is negative. Okay, so what you can do as a investor to decrease the risk, portfolio risk, you can hold either Facebook stock, right, to have as you will have negative correlation. What will happen, as Facebook's stock will go up, then Twitter's stock will go down, and retrospective effect happens given that your required return is same. Okay, so net income meanwhile more than doubled, 3.61 per share, or roughly 10.4 billion from 5.2 billion ago. Analyst estimated earnings would be about 3.1 per share. The social media company, whose suite of offerings include Instagram and its messenger service, also hit a record of 2.9 million monthly active users, up to 7% year over year. So this is one of the example of correlation, real-time, real-life example. So from here we can understand that, like from news as well, whether their correlation is positive or negative, whether their standard deviation is high or low. Of course, you can understand that standard deviation of Facebook share is also high. We have not calculated it, but you can see that although there was a rise, but rise of stock is not justifying the price. So definitely the slump in the price of Facebook means that it is reacting usually high. Standard deviation is high. Beta of Facebook also must be even better, even a little bit up, above market, right? So these are the statistics for rough estimation. But for confirmation, we have to go back and do our calculations. So any confusion in this? Or do you want to share something, add something up? I'm waiting for you. Anyone?
No, sir. No, no question.
Okay, thank you, Arsena. Okay, so then let me do your attendance and we'll move towards the class. Today we have many questions to solve, so I'll quickly rush you to the class, to our content. Today's nominee for revision is Ritesh Kumar. I think he has not joined yet. Has he? Okay. Let me start attendance. Alex, present. Arsena,
Present, sir.
present. Ashish, present. Dipesh, present. Ivan Srestha, present. Jeju, present. Marina, present. Ninju, present. Nissan, present. Ujasvi, present. Prakriti,
Present, sir.
present. Prasamja, present. Praveen, Praveen Khatri, absent. Raman, present. Ratnaprabha, present. Revision,
Present, sir.
present. Ritish, Ritish Kumar,
Sir is
absent.
absent.
Okay, Rivaj, Rivaj Prasad Junsi, absent. Okay, Ronin present. Rivaj absent. Sachyam, present. Salina, present. Sarisma,
Yes, sir.
present. Shekhar, present. Smith,
Yes, sir.
present. Swarup,
Yes, sir.
present. Eunice,
Present, sir.
present. Okay. So I'll call name of absentees. If you are there, let me know. Praveen Khatri, present. Okay, next is Ritish Kumar, Ritish absent. Next, Rivaj absent. Rivaj present. Okay, so we have only one absentee, that is Ritish. We must have total 25 students in the class. Okay, perfect. Okay, so today's nominee for revision is Ritish Kumar. Ritish, are you ready?
Ritish just joined the session. So
Yes, Archana?
Ritish just joined the session. I think. Very left bio.
Is he playing hide and seek with us or what? So Ritish is not there. Okay. Our revisor is running away from the class. Okay, so I'd like to ask someone from the floor. There is no electricity, okay. So he can come through data, isn't it? Sarisma, can you please ask him to come through data? So I'll move along with the class. When his electricity will come back, then I'll ask him to revise, okay, previous class. Till then, I'll move on with the class without revision. Sarisma, I did not get you. You want to call means? Okay. Can you please tell him that he can join when his electricity will be there and then revise? He must have prepared for the class, okay? So for then let's not wait for Riti to revise. I'll move on with the class because we have many questions to solve in this chapter. So I'd like to request someone to be reviser. We have already 9 participants who have revised, done revision. So I'll call random name. So please revise. You have to revise in the next class, okay? So Sekhar, Sekhar Paudel, can you please accept your nomination for next year's next class revision? Sekhar, we are waiting for you. Sekhar Paudel. Sekhar, please accept your nomination. I'll also write the name of a student
Yes,
who
sir.
will not accept it. Okay. Thank you, Sekhar. Sekhar, let me write your name in the roster. Okay. Okay. Okay, so we discussed about intrinsic value in the last class, how to calculate intrinsic value. If there were 2 different models, dividend discount model and enterprise model. Okay, so we are waiting for Sekhar to further revise it. Right. Moving on, this is something you can go through your own, because yesterday we understood enterprise value model through a question, isn't it? So I think that was the last thing we did. So how to value preferred stock? Preferred stock valuation of preferred stock is like valuing perpetuity. Okay. In the time value of money, we learned how to find the value of perpetuity, isn't it? Likewise, V is equal to dividend divided by return. How much dividend is going to be, we are going to receive for perpetuity. Let us do one example. What would be the value of preferred stock if its dividend is 10 per year and its required return is 10.3? So when you simply divide dividend by required return, then you get value of price of value of preferred share. So like bonds, preferred stock has a par value and a fixed dividend. However, preferred dividend can be omitted without throwing the company into bankruptcy. Now, what does it mean? Preferred dividend can be omitted without throwing the company into bankruptcy. If let us take an example, Facebook is going to collapse, okay, like Twitter and Snapchat are going into popularity and it is taking market share of Facebook. Now Facebook is moving towards bankruptcy. So in that point, Facebook anyway has to pay its creditor or its loan providers, anyway, lenders anyway, it has to pay it. But there is no compulsion for Facebook to pay to its preferred stockholders if in the case of bankruptcy or adverse situation. But please note that preference stockholders get preference over dividend over equity shareholders. First of all, company has to pay to creditors, then it has to pay preference shareholders, and then only equity share will get the last whatever is left out of all the profit. Okay, and also the second point, preference stockholders usually have fixed amount of dividend. They usually have fixed amount of dividend. If company makes huge amount of profit, doesn't matter to preference stockholders because they are going to get that fixed coupon rate like bonds, right? But in the case of equity shareholders, their risk is high. They can get, as company will perform better, they can get huge amount of return. And if company performs weak, then they get less amount of return. In this case, now it is written that yes, if Facebook goes to bankruptcy, there is no need for Facebook to pay to its preference stockholders. That is one kind of legal aspect and properties of preference stockholders. Okay, so how to calculate the value? So you can see the example as well. So any confusion in finding value of preference stockholders? It's comparatively really easy, you know, in comparison to enterprise value model, and compared to dividend discount model. Any confusion in this, or shall I move on? Just next slide.
So move on.
Okay, thank you, Arsana. So now we have come to an end of chapter. It is some few tips for revision. One, it is necessary to know how stock prices are established before attempting to measure how a given decision will affect a specific firm's value. So we must understand how that price is calculated. Now I have been showing you some of the websites, isn't it? Like for an example, for example, sharesansar.com, right? I told you if you want to find ratios of Nobel Bank or any other stock, then you just type script here, then you'll get the prices here, right? And to see the ratios, you go to financial quarterly report, key metrics, then you'll see different ratios, right? But before taking anything into consideration, right? For example, here is return on equity 15, right? And also P ratio of 37. So you might think that, okay, Nobel Bank's return on equity is really good, so maybe I want to invest in this company. But before that, please understand on what basis that ratios or any of the data is given. You have to, as a financial analyst, you cannot rely to the data unless you verify the source of data. Here, the source of data is third quarter. Please also make sure that you download Nobel Bank's quarterly report of third quarter and then compare it one or two, and if it is correct, then only rely on this data. Otherwise, if you are going to invest your money, hard-earned money, then always make sure that you know its source and reliance of the data. Okay, and also second point, now fourth quarter report is going to come after end of this Shravan, right? Nepal Rashtra Bank has extended 15 days for banks to extend their report. Okay, so you will get reports of all the banks, tentative report, unaudited ones of all 27 banks of country. So till then, now is it prudent to rely on this ratio in these ratios? Of course not. Why? Because new report is about to come, right? And a lot of times this P ratio was calculated when in the last third quarter. It was of Chaitra's end, and after Chaitra there has been huge up and down of the shares price. So this stock will not hold true for you to calculate. So that is one example why not to rely on data, and it verifies it definitely verifies this first point. Okay, so it is necessary to know how stock prices are established. Okay, please make sure that you know the source data as well. Next, two stocks of valuation models were discussed. One was a dividend discount model or discounted dividend model. It's also called dividend discount model, or usually it's called the discounted dividend model. And second, first, when you calculate intrinsic value through this, when you know dividends of company, when the companies usually give dividend to its shareholders. And on the other part, there is another valuation technique, that is the corporation valuation model, which we discussed in the last class. And according to this model, you generally follow this model when dividends are not known, when you don't know dividend given by the company, correct? So moving on, finally preferred stock value is determined like a perpetuity. So we have come to an end of this chapter, return, risk and returns. So it is a right time if you want to ask any question from 1 to slide 41. I'll be happy to answer. If not, then we'll move towards solving our question. I'll give you 20 seconds. If you have question, then I'll be replying questions. Any question from the slides? So we have covered risk and return trade-off, standalone risk, CAPM theory, relationship between risk and return, concerns about beta and CAPM, concluding thoughts, stock price intrinsic value, dividend discount model, constant growth model, valuing non-constant growth model, enterprise-based approach, and preferred stock. Right. Okay. So I don't think you have any questions. So let me move on to practical questions. Okay, let's start from rates of return. I have got 1, 2, 3, 4, 5 different questions for you. I think one question we solved in the last time. 6, 5, 6, 7, 8. 8 questions. But let's start from rate of return. Okay, I think it is one of the practically important questions. These kind of questions you may see in your final examination. Okay, so realize rate of return. Stock A and B have the following historical returns: year 2013, 14, 15, 16. I think it's more visible like this. Okay, 13, 14, 15, 16, and 17. Okay, and we have been given stock of stock A, returns of stock A over the period of 5 years, 13 to 2017. In the year 2013, return was 24.25%, then 18.15 in 2014. Likewise, in 2017, it was 39.13%. Similarly, in stock B, in the case of stock B, we have 5.5% as a return in the year 2013. As you move on, there is only one negative return of 4.5% in 2016, correct? So finally, in 2017, we have return of 43.86%. So let us see what question has to ask us. Calculate the average return for each stock during the period 2013 through 2017. And second, assume that someone held a portfolio consisting of 50% of stock A and 50% of stock B. What would the realized rate of return on the portfolio have been in each year from 2013 through 2017? What would the average return on the portfolio have been during that period? Sounds easy, isn't it? We have done similar questions for Martin products, right, and US Waters. Do you remember? So if you have already forgotten it, no worries. Today we will understand again. Now from 2013 to 17, what we'll do? First of all, we'll find mean, then we'll find variance, and then we'll find standard deviation in the case of question B. But let us solve this first part of point A. Calculate the average rate of return for each stock during the period of 2013 through 2018. So question is asking us average rate of return. How shall we find average? We have been given return of each period. So if we calculate mean, or I would say average of all the returns, then we simply get average. So how can we do this? See in the answer you can see. So we just add all these. It's a child's mathematics. 1, 2, 3, 4, 5. We add all these stocks, right? So there is a negative return of 24.25% in year 2013 for return A, right? So we input negative here 24.25, then positive 18, and positive 38. Likewise, we follow up to 39.13. We add all these returns, and then we divide it by number of samples. Our sample period is 1, 2, 3, 4, 5. 5 period, 5. So as we divide by 5, we get our answer 17.276%. Very, very simple. There is nothing much to understand here. Similarly, in the case of return stock B as well, we add all these 5 stocks, 5, 5, 26. Please note that this fourth year, 2016's return, it's negative 4.5. So please input negative. It will reduce this overall stock, right? But you have to take like this and divide it by 5. Then you get your answer 23%. If someone comes and asks you what is the average return of stock A, then you can find 17%. Do you want to see one practical example as well? If you want to see one practical example, let us see of this Nobel Bank dividend history. Okay. So what are the dividends? 35, 34, 34, 48, 45. So if someone asks you, sir, what is the average return of Nobel Bank stock? Okay. Okay. So here it is. So how can you calculate? 35 point, what is the total dividend? 0.26. Next 34. Next 34, 48, and 45. So what is the total of return 5 years? So we are taking sample of 5 years. You can take sample of 3 years. It is up to you. It's completely up to you. Okay. If you feel that 3 year will work for you, right? So it's up to you as a financial analyst. It is our total. As we will divide this by 5, then what is the average return of Nobel Bank? It's 39.25%, right? So likewise, if you take sample of 3 years, 1, 2, and 3, 35, 34, and only 3 years only, then I think it's a little bit lower, because Nobel used to give a little bit more, divide by 3 number of samples. So it's 34%, right? So one takeaway from this case is that your average return is drastically influenced by number of samples you take. So I advise you to take maybe 5 samples. It's kind of like everywhere we usually take a sample of 5 years, but it's not necessary for you to there is no hard and fast rule that you have to take sample for 5 years. Okay, so you can take for 5 years or 3 years. So this is the practical case. So let's move on with the question. Okay, here again, so going back to the question 17 and 23. Now again, our first question is solved, isn't it? Calculate the average rate of return for each stock during 13 to 27. Done? Done. This is our answer, 17, 23. Second part, assume that someone held a portfolio. For an example, Jeju bought both stocks, stock A and B. Someone means Jeju, for an example. Jeju held a portfolio containing 50% of stock A. He bought 50% of stock A and 50% of stock B. What would the realized rate of return on the portfolio have been in each year from 2013 through 17? Again, we have been asked to find realized return of the jungle, not leopard or not elephant. Portfolio means jungle, right? So what is the portfolio required return or mean return of portfolio? That's the question asked. Okay, so how can we find? Now for 2013, we'll simply add these two, 24 and 5.5. Okay, how will we do that? Is equal to bracket minus 24.25% plus 5.50% divided by samples 2. You get your answer 9.38%. Okay, this is the percentage in negative. This answer. So likewise, what do you do in 2014? You add these two, 18.50, right, and 26.73, and you divide it by 2. Please keep these in bracket. Right. So likewise, you can add. Okay, sorry. You can have input direct formula. So likewise, you can add for all the stocks. Okay. So and then as you will find average return for from 2013 to 2017, then you'll sum it up and then divide it by number of samples. Now, if this holds stock A and stock B for both year 1 and year 2, sorry, both returns from 2013 to 17, then our mean for portfolio is 20.62%. Okay. So if someone asks, Jeju, how much required return you have according to the past history of these stocks, then he will definitely tell that, yeah, I am expecting 20.62% on the basis of past data. Okay. So our question is solved. Question B. Calculate the standard deviation of returns for each stock and for the portfolio. Use equation 8.2. So we have been asked standard deviation. Now, how can we find standard deviation? We learned that standard deviation is spread, isn't it? You can see here, this is the spread. This is the spread. Standard deviation means spread, isn't it? This is mean as how far other returns will go from our expected return. That is called standard deviation. What is the chances of not having that required return? That is standard deviation, correct? So likewise, in second case of US water as well, that is the case of standard deviation, right? So moving on, now let us find that deviation. How much is the chances of not having that stuff? So the formula of standard deviation is square root summation of RT means return of that particular stock minus R average, return of average. These are average which we have found 23, 17, and 20, right? So then first of all we find RT minus R average, right, this portion, and then we divide it, we'll square it, and then we summate it, and then we divide by n minus 1, and then we square root. Likewise we calculate it. Okay, so square root bracket for summation, what we'll do, 24.25 minus 17. Now we are trying to find standard deviation of A first, right? First we will find for A, then we will find for B, and then we will find for portfolio RAB for A and B. Okay, so for A, let us see, our mean is 17, our return for that year is 24.25. so how can we find minus 24.25 minus our mean of 17? Likewise, can you tell how much it will be for 2014? It will be simply 18.50 minus 17.28. How far away is this 18% from our mean? How far away is this 38% from our 17? That is it, if you want to like interpret in language. Likewise, you continue up to 7. Now n means number of samples, 5, or number of years into consideration. Number of years into consideration are 5, right? 5 minus 1 is 4. So when you square root the answer, then you get your answer 25.84%. Now what does it mean? What does 25.84% mean? It simply means that the chances of not getting return of 17.28% is 25.84%, right? So that is the risk, isn't it? So diversifying our portfolio, like Jeju, what Jeju is trying to do is that wait, I have my required return is 20%. Okay, my required return is 20%, and keeping 20% constant. Keeping 20% constant, I want to reduce the standard deviation of 25.84%. So JJ is trying to diversify his portfolio. So likewise, you can calculate standard deviation of stock B and portfolio AB. Now what we'll do for portfolio AB, one example, our mean return is 20, for year 13 is 9. So what we'll do, minus 9.40 bracket, first of all bracket, minus 9.38 minus how much? 20.62. It means that how far it is going away from 20.62. Then you add, again, you'll continue like that. You'll add square of it, the power square, then you add again. What will do? 22.62, this one for 2014, and then you subtract it by 20 point our mean 62, then bracket close, then to the power 2. So likewise, you will continue and calculate your answer. Okay, I hope you have no confusion up to here. Okay, so like in portfolio, you find AB. Now what do you observe from this? What do you observe from this line? Standard deviation of A is 25.84, standard deviation of B is 23.15, and portfolio AB is 22.96. So what do you observe from this? We have bright stars in every class, as you know. So I'm asking to those stars, please respond. What do you observe from this? So anyone? What is the observation from this data? Okay, no observation. Okay, so later on you can see the recording, if not then. Okay, let me explain you. Stock A's deviation was 25, risk was 25%. Stock B's deviation was 23. Interestingly, portfolio AB's standard deviation is 22.96, isn't it? Did you get it? When we diversified our portfolio, the risk decreased. When we diversified our portfolio, the risk decreased. Okay. So third, we have solved this. Calculate the standard deviation of return for each stock for the portfolio. Use equation 8.2. See, assume the risk-free rate during this time was 3.5%. Maybe FD rate of 3.5%. What are the Sharpe ratios for stock A and B and the portfolio over this period using their average return? What was the formula of Sharpe ratio? Sharpe ratio was return minus risk-free divided by standard deviation, right? Return minus risk-free by standard deviation. So we have got standard deviation here, right? Our return risk-free rate is 3.5 for all the stocks, and our required return is 17 for A, 23 for B, and 20.62, 20.20.62 for portfolio, right? So what we'll do? 17 minus for stock E, 17 is required return. 17 you can see here, 17 minus risk-free 3.5%, and you divide it by 25.84. You get your answer 0.5333. Likewise, what we'll do for stock B? For stock B, your return is 20, average return is 23.97, risk-free rate is given in question 3.5. 23 minus 3.5 divided by standard deviation 22.96. Right? So likewise, we found our Sharpe ratio to be 0.53, 0.88, and 0.75. So which stock is better? B is better, isn't it? Higher the Sharpe ratio, better the stock is. So looking, what are the Sharpe ratio for a portfolio over a period of time? We have solved that. Now D, looking at the annual return on two stocks, would you guess that the correlation coefficient between the two stocks is closer to plus 0.8 or plus or minus 0.8? Now this D number, if you understand this, then in master's level also you will not have problem with finance. This D number. Looking and in tomorrow's multiple choice question as well, please, if you do not understand this, you are going to lose some of the marks. Looking at the annual returns on the two stocks, would you guess that the correlation coefficient between the two stocks is closer to plus 0.8 or plus minus 8? It's definitely how much? It's plus 0.8, isn't it? If it was minus 0.8, then we would have great amount of difference between here in this 22.96. It would have decreased by huge lot, right? Rather than a fractional change. Because the risk reduction from diversification is small. How much was the risk reduction? It was just you see from B perspective, it's from the A's perspective it was 2.8, from the B's perspective it was 0.19 only. So it was fractional change only. Because the risk reduction from diversification is small, this standard deviation of AB falls only to 22.96. So it must have positive correlation only. The most likely value of correlation is 0.8. If the correlation was minus 0.8, the risk reduction would be much larger. In fact, the correlation coefficient between stock A and B is 0.76. So our correlation coefficient was 0.76 in fact in actual data. So what does it mean? It means that correlation coefficient, if it was negative, let me give you an example. Coca-Cola and Pepsi. Let us take share price. Okay. Share price of Coca-Cola is 234. Share price of Pepsi is around 340. It's hypothetical situation. Okay. So now what does it mean? This one, what does it mean? Correlation. Now correlation, we are trying to find correlation. Now our portfolio, if we have Coca, Pepsi, this is jungle, Coca, Pepsi is jungle, like we have both the portfolios. What we'll do? We have 50% of Coca-Cola and 50% of Pepsi, right? 287 for an example, right? So if correlation is positive one, what happens? Correlation between Pepsi and Coca-Cola is positive one. Positive one. Let me give you both example, negative one. So what will happen if relationship, now you know that, you must know up to now that beta means relationship of particular stock with New York Stock Exchange. Giving like concluding like beta. Okay. So change of Coca-Cola per unit change of New York Stock Exchange or whole market is called beta. But change of Coca-Cola against change of Pepsi or change of Pepsi against change of Coca-Cola share price is called correlation. Okay, so whenever Pepsi goes up, Coca-Cola might go up or go down, right? There must be some relationship between stock. So that is something we must establish, right? And likewise, let us take an example. In the case of Coca-Cola, if stock price went up by, for an example, 10, stock market went up by 10, Coca-Cola is also moving up by 10 points, right? If correlation is 1, what does it mean? It means that Pepsi is also going by 10, right? It is also moving up equally like Coca-Cola or in equal proportion, maybe equal percentage like in this point, okay? So what can you see? If it is in positive, the risk is increasing, isn't it? It's going up, it is also going up. So our risk is increasing, risk is rising because both the case, they both are going up. Now, if beta is -1, what happens is that if Coca-Cola goes up by 10, okay, so we have to add in portfolio price of 10 then, okay? So our price is now 307. So in terms of portfolio, our risk went up. But in the case when, let us take an example of negative correlation, when Coca-Cola went up by 10, right? In the case of negative correlation, what happens? Pepsi will go down by -10 equally, okay? So what is the impact in our portfolio? Impact is 0, right? Impact is 0, isn't it? So this is a classic case. -1 correlation is the classic case of diversifying your portfolio. Whenever you want to diversify your portfolio, always have stocks which have negative correlation so that whenever one stock will go up, another will cancel it out. Okay, I hope I made myself clear. Anyone who did not understand this? If not, then I'll again explain with another example. Anyone? It is very important to understand. You know, correlation is very important one. Tomorrow you might want to find relationship between Nepal Bank and Nobel Bank, isn't it? Or Nepal Bank or uh, Himalayan Distillery. They might have like slim correlation, but right. Maybe NICIA and Nobel Bank might have negative correlation, right? So you would love to have know these correlation between two stocks, isn't it? So anything you want me to make you clear? Any confusion in correlation, concept of correlation? Or shall I move on to point E?
Sir, it is understood. You can move
Thank you.
on.
I'm really happy that you guys understand everything in one say. But yeah, if you did not, you wanna like understand later, you can go through video as well. Okay.
We understand now, we forget later.
Okay. Thank you, Arjuna. Okay, so because the risk reduction for diversification is small, right? It was small change in diversification, right? Now, what would happen if here was, for an example, if this was 5%, right? We can definitely guess that this correlation was negative, right? Correlation was negative, and we did wonderful job selecting stock. Like Jeju selected stock B and 50% of stock A. He did not do wonderful job. Why? Because his change in risk in portfolio did not vary much. So its correlation might be positive because there was slim difference between stock A's standard deviation and portfolio's deviation. If it was 5%, then we would definitely have told that, see, there is a huge difference between deviation. So wonderful job done on selection of stock. And what does that mean? That means that maybe Jeju selected stock which had negative correlation in huge terms, maybe negative 9, then 0.9, great, negative 0.1, great, no, 0.8, wonderful job, right? So like that. Okay. So moving on. Part E, if more randomly selected stocks have been included in the portfolio, which of the following is the most accurate statement of what would have happened to portfolio P? If Jeju had randomly selected any of the stock, okay, so then standard deviation would have remained constant, or standard deviation would have been in vicinity of 20, or standard deviation would decline to 0. Which one would you select? In the case of E, if the more randomly selected stocks were added to the portfolio, would portfolio standard deviation of P would decline to somewhere in the vicinity of 20%. P would remain constant only if correlation were +1. So if correlation was 1, then only it would it will increase the risk and remain the price into constant, which is most unlikely. And P would standard deviation of P would decline to 0 only if correlation were equal to 0. Correlation was 0, then negative, it would standard deviation would also decline. And a large number of stocks were added to portfolio, or if proper proportions, please note, if proper proportions were held in two stock portfolio, standard deviation would be 4 would be -1. This is 4 is equal to -1, then standard deviation would reduce. Same concept. Since it took a lot of time, this question, so let us move on to, I'll little bit speed up, okay, since we have to cover more questions. Okay, so this second concept is about required rate of return, right? ECRI Corporation is a holding company with 4 major subsidiaries. The percentage of its capital investment invested in each of the subsidiaries and their respective betas are as follows. Now this question is a beta. Electric utility is 60%. Now there are 4 departments of this company: ECRI Corporation, ECRI Corporation. Electric utility 60%, cable 25, 85. Then when you add real estate 10, 95, and then international projects 5. Okay, beta of each division is 0.7 for electric, cable 0.9, real estate 1.3, and international is specific person. What does it mean? They are listed differently in stock market, right? And their beta is calculated differently. So what is the holding company's beta? Holding companies means one which holds all these 4 companies, right? That is, now holding company is also called holding company. Holding company is also equal to portfolio, isn't it? Now here in this case, holding company is portfolio. So what you'll do, you will simply add the percentage of beta, isn't it? You can do weighted average of beta, you can do weighted average of returns. You cannot do weighted average of standard deviation. Why? Because when you bring stocks together, its risk decreases or standard deviation decreases, isn't it? So when you simply weight it, multiply 0.6 with 0.7 beta of electric utility. Likewise, you multiply percentage of cable company with beta of cable company 0.9. Again, so you add all these 4, you get the beta of portfolio. Beta of whole holding company is 0.85. I hope it's clear. Second, if the risk-free rate is 4% and the market premium is 5, what is the holding company's required rate of return? According to CAPM theory, CAPM, right? Now, what is the CAPM? If you tell me that what is the CAPM right now, then that is proof of your not attending, not being attentive. Capital asset pricing model. I have to show you in the slide. So in the slide. Yeah, here is the formula. Required return on any stock is equal to risk-free rate plus market risk premium into stock beta. Please note it down. Okay, so risk-free, we have been asked required return, so we apply this formula. One of the most used formula in finance. Okay, so what is this for? For is risk-free return, right? For is risk-free return means FD rates, Treasury, US Treasury bond rates, 4%. Market risk premium 5 into beta 0.85. Then you got your answer 8.25. I hope you are clear. ECRI is considering a change in strategic focus. It will reduce its reliance on electric subsidiary. You can see that electric unit is 60%. So Reliance is trying to strategically shifting its focus towards another division. So the percentage of its capital in its subsidiary will be reduced to 50. Now it wants to reduce 60 to 50. At the same time, it will increase its reliance on international and specific projects to what percentage? 15%. What will be the company required rate of return after this change? Again, it's really simple. You just change the weight of electric utility 0.5 into 7 and increase weight of international from 5 to 15. Here is 5. Now you add to 15. Then you get your beta. Then again calculate like this. You get your answer 8.65. Very simple, but yet very important. Any confusion in this?
No, sir.
No confusion. No confusion. Okay, so let's move on. Next, constant growth stock valuation. Okay, let us solve this one. It is one of the part of dividend discount model. So Fletcher company current stock price is 36. Current stock price in stock market is 36. Its last dividend was 2.4 and its required rate of return is 12%. If the dividend are expected to grow at a constant rate G in the future, and if RS is expected to remain at 12, what is the Fletcher's expected stock price 5 years from now? What are the equation? What are the details we have been given? Stock price. Sometimes please note that these questions are tricky. You know, they give details which are not required for you to calculate as well. And last dividend means last dividend. What is this? Is it D0, D0 or D1? What is this? Last dividend means. This is the place where you might get confused. In the last class also I tried to explain it. Please make sure that when it's called last dividend which was distributed was in the past tense, this kind of question comes, then it's always D0. Okay, it's not D1, but formula requires D1. In the formula of dividend discount model, discounted dividend model, it requires future dividend, not past. Okay, so you always have to add growth to D0. I explained this in last class. So it was 2.4, correct? 2.4. So R was how much is R required rate of return? 12%. If the dividend are expected to grow at, what is the G? Grow in the future at the rate of 12%, right? Required return is also 12. Your expected dividend growth rate is also 12. What is the Fletcher's stock price at 5 years from now? What is the price? 5 years. So we find through dividend discount model, we find our answer. So you can see price is equal to 2.4 means D0, right? 1 plus G, so it is trying to find D1. Please do not get confused in this. Here is D1, right? You can see to find D1, it is simply adding growth to D0. 2.4 into 1.12 or 1 plus 0.12. Then you get your answer here. And then, so our price was given 36. So first of all, we are trying to find growth in this stock. Growth in the future, right? So it was second part of the question. If dividend are expected to grow at a constant rate of G in the future, and if RS is expected, no, RS, it was not growth. You did not correct me, It's not given. Not given. It was written, RS is expected to remain at 12, not growth, right? If dividend are expected to grow at a constant rate G in the future, and if RS is expected to grow, then what is the pledger's stock price 5 years from now? So first of all, we find G, then now you can solve this question to find 5%. And then next step, P5, we need to find price. P5. For P5, what do we need? D6. We divide it by required return because required return is constant, right? Remain constant to 12. Right. So 0.12 minus G is, how much was the G? 5%. So 0.05. And you get your answer from this then. So like this, we'll calculate. Okay. So here you can see 2.4 discounted up to 1.056 times. 1, 2, 3, 4, 5, 6, like this 6 times. And then you get your answer D0. And then you divide it by required return and growth. Then your answer is 45.95. Okay. So what you also alternatively can do, if you add the value of 36 is P1, right? As 36 is P, price of the stock, and you can also discount it 5 times. Then you get your answer 45. Therefore, the firm's expected stock price is 45. Any confusion in this? Very, very simple. I think you can solve it now. You know the formula, you know what are required. I gave you places where you might get confused. So there must not be any query to this. So if you have query, let me know. If not, then I'll move on to the next question. Shall I move on? Shall I move on? So no confusion? No? Okay. I take it that as no.
No, sir. Not right now.
Thank you. Okay. I think that was even better answer. Not right now. Usually, no, a lot of times, when you go back and like think, then you'll understand. Like, I might have confusion in these area, right? So that might be the case as well. Okay. So this one, non-constant growth stock valuation. We have now in this question. This is the last question for today. We have already done this corporate valuation model. Okay, Snyder Computer Inc. is experiencing rapid growth. Earning and dividends are growing to, now let me input, earning and growth at the rate of 15%. What is 15%? During the next year? During the next 2 years at 13%. Okay, now we have been given non-constant growth, isn't it? So for 2 years, how much? During the 2 years? During the next 2 years, it is going to grow by 13%. Then following year at a constant rate of constant. From when? Constant rate of 6%. After that, during year 4. And thereafter, its last dividend was last. Please note, last means past. Dividend means B0 is 1.15. And its required rate of return, RE was 12. Always please note that whenever we come to a point where from when dividend is always constant, we come to the point when growth is constant, right? In any case, right, when it moves up, like I give you an example of Google and Facebook. In initial days of Google, Microsoft, Facebook, or whatever the company which is growing, their growth always goes up, right? And then it constantly moves up. But at certain point, when it matures, when company attains highest attainable point, then at that point, from that point, that dividend or price or a lot of other metrics remains constant. It's true for every other metrics of finance. So likewise, whenever we have that constant point, from there we can simply add that formula of dividend discount model, and then we can find share price up to that period, and we discount that period up to present. Okay, so like this, we can now solve this question. Calculate the value of stock today. For 2 years, we will calculate separately. For this constant one, we do as we did in constant growth, right? We apply that formula, and then we solve the problem. So D1, for D1, how can we calculate D1, D2, D3? We simply add growth of 15%, right? G of 15, right? So as we'll add D1, this was D0, D0 plus growth of 0.15, right? 1.15 into 1 plus 0.15, we get our answer 1.3225. Likewise, we get our answer D2 and D3. Now, what is our present value of these all dividends? We discount these all dividends. See, here you can see 1.3225 is dividend of first year. Second, 1.5209 is dividend of second year. And third, 1.71 is dividend of third year. Now we bring it to present, we bring it to present, we bring this to present. Why? Because we are in present. We like to take decision right now, right? So answer is 3.6. Now present value of form. Now we are trying to find present of this constant part. The constant thing happened when growth of these companies stock started to remain constant when after third year, isn't it? So for this we can calculate through this formula of constant growth rate. What is the formula? Price is equal to dividend 1 plus Z by required return plus C, minus C. So P3 is equal to D4 by required return minus C. You get your answer 30. So here we get our answer 30.36. We discount it. We have to bring this 30.36 to present. So we divide it by how many times? From 3 to 2, 1, 2 to 1 to 1 to 0, 3 times. We discount 3 times. We got our answer as 21.61. So we add 21.61 with 3.6, then we get a total value of this stock today. So that was 25.23. Okay. So this is our answer. Second, calculate P1 and P2. Now we have got price of we have got the stock price of 0. Then we have been asked price of 1 and price of 2. How will you find? We simply now for P1, what was it? 1.15 was in year 1. So like that, we discount 1.05, discount it by 1.12, right? And for 1.7, second one. So this one of year 2 dividend, we bring it to first year once. This one 2 times, 1, 2, twice. This is constant. 30.36 also we bring it to 1, 2. We discount here. So we are here. We have been asked what? P1, right? So we are here. P1. We want to calculate here. P1. So this one once. This one 1, 2. This one 1, 2. So that is what question is doing. 1.5 one time, 1.12, 1.7 2 time, 1, 2, and 32 time 1, 2, 1.12 to the power square. Correct? So you find your answer 26.93. Likewise, in the case of P2, now you can tell me the answer for P2. We are here. What? How much is the answer? 1.5209, right? So this 1.7 and we discount how many times? 1 time. You discount it 30 by 1 time. 1.12, 1.12. Then you get your answer 28.6416. So last one, calculate the dividend and capital gain yields for 1 to 3. Now dividend you know, right? What is capital gain yield? We know price of year 1, price of year 2, and price of year 3. For an example, Nobel Bank stock in 74, 75, 75, 76. Now this is very important. Please be attentive. This was 1, 2, 3. Let us take an example. Price of Nobel Bank was 600. Then if share price. This is share price. Nobel Bank, okay. Okay, Nobel Bank. Now, year 1, 2, 3, 74, 75, 76 stock price. Let us assume it was in 1200. Now it's in 1400, right? So Nobel stock from 1 to 3, okay, share price in 74, 75 at the end it was 600. It jumped to 1200. It jumped to 1400. Now one is, let me show you that. Let me show you practically, okay? Now you can see what are the two things you got. Dividend, you are getting dividend from Nobel Bank. How much? 74, 75, 74, 75, 34%, right? 34%. Then 75, 76. How much dividend did you get? 34%. Wow, it's constant, you know. 34%. Next, 75, 76. How much? 35.26%. 35.26%, right? So you got the dividend as a shareholder. One part is you earn by dividend. Second part is you earn by capital gain. Let us assume that you did not sell any of shares of Nobel Bank. So how much capital gain did you get? You minus 1400 by 1200 once, then again 1200 by 600. You gained 200 rupees in the interval of 1 year, from third to second year, and then from second to first you earn. So you earned around 800 rupees per share. It is per share, you know, per share. 800 rupees per share, okay, in the Nobel Bank. It's called capital gain. Capital gain in other terms, okay. Also called capital yield, like Mahadev, Shivaji, right? Nilkant, whatever it is. Capital yield, capital gain, right? Per share, you earned 800 rupees from Nobel Bank, right? According, as for the dividend, how much did you earn? You earned an average of, how much did you earn? You earn on an average of 30, how much percent? Average of, it's not 2, it's 3, number of samples are 3, right? So on 34.42%, right? So these two both add up to your return on investment, okay? So that is something you need to understand here. Calculate the dividend and capital gain. It is asking this dividend yield and this capital gain yield. Capital gain yield of year 1, 2, and 3. This was year 1, year 2, and year 3. Now we have done for Nobel Bank. We can definitely do it for this stock as well, isn't it? So we have got the price here. We need detail of price, isn't it? So we have calculated price. P3 was 21, right? P3 was 21. Here you can see 26 was price of year 1, 25 was price of year 0, and 25. What is the price? Price 0 was 25.23, right? P0. It is also given in question. What is the price in the initial time? It was 25, right? We have calculated it here. So price P0 is equal to 25.23. Price is 25.23. We minus it by price of year 1. Price of year 1 is P1 is 26. So 26 minus 25 divided by 25, we get capital gain yield of 6%. Likewise, P2 minus P1 divided by P1. P3 minus P2 minus P3 minus P2 divided by P2, then you get 6%. Likewise, dividend yield 5%. How do you find that? Dividend divided by price, isn't it? Dividend was 1.3. How much? 1.3. It is price. Dividend was 1.3, 1.5, 1.7, 1.3, 1.5, 1.7. You divide it by 25, 26, 28, and you get your yield. So how much was the total return? Total return was not only dividend, it was capital gain yield as well. So total return was 12%, 12%, 12% in all the three cases. So any confusion in this question? Did you understand it? I give you practical example as well so that you could calculate it real time as well.
Yes, sir. Understood.
Okay, thank you, Arsena. So I think we are done with questions. I think we. Okay. Okay, so अब हामी we have come to an end. तपाईहरुलाई मल्टिपल चोइस क्वेशनहरु सल्भ गर्दाखेरि I'll also मैले यो I learned मा हाल्दिए जस्तो लाग्छ है. Let me see. तपाईहरुको I learned मा हाले कि हालिन?
Sir, when will be the multiple choice question thing?
You'll be notified by management. I'm submitting answer and questions to management after this class.
Okay.
आज भर्खरै बनाएको हो अनि अब इट्स लिक्ड एज वेल म तपाईहरुलाई आन्सर नै भनिदिन्छु स्लाइडहरु र यो क्वेशनहरु तपाईहरुले रिभिजन गर्नुभयो भने लगभग यु एटलिस्ट यु मस्ट गेट मोर देन 80%. त्यो भन्दा बढी चाहिँ अब कन्सेप्ट पनि बुझेको हुनु पर्यो. सो प्लिज गो थ्रु इट. सुन हुन्छ छिटै हुन्छ होला. अनि सेक्सन ए र बी को हुन्छ भने चाहिँ फ्राइडे तिर हुन्छ कि म्यानेजमेन्ट विल इन्फर्म यु अकर्डिङ टु
Okay. Sir, and you have said that we need to buy one stock and analyze it or something like that. Ni? When
Yeah.
will that start?
That will start from August.
August?
August, yeah. I
Okay,
will
so
float that. Yeah,
1 month analysis we have to do.
yeah. You have to do 1 month analysis, and from that analysis, you have to like maximize your profit, right? One matrix is that. But if you gained loss also, it doesn't mean that you are not going to get marks. If you gained loss, you have to give valid reasons why you lost it. Okay. So likewise, I'll give you
Okay.
the framework of how to do analysis. You have to calculate standard deviation, beta, and now we know correlation, and whatever the metrics we can solve from learning outcome 1 to learning outcome 5. Whatever the analysis you can do, you can inculcate everything. Okay, and you have to find answer
Sir,
like that. And yes,
like I have like out of syllabus question. Can I ask?
yeah, please.
Sir, I'm a little confused about how to look at the index, just like RSI and all, RSI and MACD.
Okay.
And is it quite important here or not?
No, I think but that is technical analysis. That is great if you delve into technical analysis and see, because like psychology of investor matters a lot, right? And those technical analysis means like how would people react according to market, isn't it? So in Nepal, fundamental aspect is a little bit heavier than technical.
Yeah.
If you want to trade mature markets, you cannot not learn. You cannot afford to not learn these technical analysis. RSI, moving average 5, moving average 20 days, 180 days to 120 days, right? And this kind of index you have to learn anyway. अब यसमा चाहिँ अब I can refer you good YouTube video. Personally, I can send you video and you can see that. अब क्लासमा त it takes like more than I think more than 1 month to understand all. Straight तपाईँले मजाले हेर्नुभयो भने 1 month त लाग्छ मजाले बुझ्नलाई तर yeah it's always great to learn that as well.
Sir,
Technical
please refer if you
हजुर
get
म
time.
तपाईँलाई म युट्युब कुनै एउटा राम्रो मैले एउटा हेरे पनि थिएँ पहिला 2 years ago मैले एकदमै राम्रो थियो एउटा भिडियो सिम्पल 1 hour को थियो क्यान्डलस्टिकहरू बुझ्नुभयो भने जस्तै फर एन एक्जाम्पल एउटा म भनिदिइहालौँ न तपाईँले सोधिहाल्नु भयो अब फर बेनिफिट अफ अदर्स एज वेल अहिलेलाई चाहिँ दिस इज नेप्से अल्फा है यसमा अलिअलि हेर्नुभयो भने अब one thing what you can see भन्दाखेरि कति हाईसम्म गएको छ यसरी हेर्न मिल्छ के इफ यु आर गोइङ टु इन्भेस्ट इन एनी स्टक हिजो मैले एनआइएल 2 दिन अगाडि वी वेयर पोजिटिभ अबाउट एनआइएल वाइ भन्दाखेरि लाइक इट्स हाई वाज तपाईँको कति थियो एराउन्ड 1649 होइन बुल रनमा यतिसम्म माथि गएको थियो अनि इट वेन्ट डाउन अप टु हियर है यहाँबाट फेरि मार्केट वेन्ट डाउन सपोर्ट लेभल कहाँ छ यहाँ छ एउटा सपोर्ट लेभल यहाँ छ है दुईटा होइन दुईटा तपाईँको यो दुईटा लेभल यहाँ छ भने चाहिँ योभन्दा डाउन जाँदैन भन्ने हिसाबले यहाँ पुगेपछि चाहिँ इट वाज द बेस्ट बाई जोन भन्छ कि अदरवाइज अर्को त तपाईँको यहीँ तल आउनु पर्थ्यो नि है यहाँ हुनु पर्थ्यो थर्ड है सो इट वाज द बाई जोन सो ऱ्यान्डमली हेर्दाखेरि चाहिँ यो पनि म्याटर गर्छ अर्को भनेको भोल्युम यहाँ तल भोल्युम हेर्नुहुन्छ नि भोल्युम हाई हुँदै गयो नि अब फर इक्जाम्पल यहाँ तपाईँको ठ्याक्क भोल्युमको इन्ट्रोडक्सन अलि हेभी छ क्या हेर्नु है यसरी हाई हुने बित्तिकै मार्केट इज डेस्टिन टु गो अप के किनभने समवन इज प्लेइङ विथ द स्टक अब नेपालको अलिकति एनालाइसिस ट्रेन्डमा यु क्यान ह्याभ युर ओन पर्सपेक्टिभ हाम्रो अब्जर्भेसन चाहिँ त्यो हाम्रो टिमको अब्जर्भेसन चाहिँ नेक्स्ट भनेको अब यो वेन इट गोज डाउन ह्युजली होइन इट हेज टु कम अप के एनिवे सो नेको वाज वान ह्युज
को पनि आई बट होइन तर एकैचोटि घट्यो होइन फाइदा भनेर बसिरहेको थिएँ अनि पछि फेरि रिसेन्टली अब इन्क्रिजिङ फेजमा छ
या सो अब एस्टरडे इन्भेस्टर्सहरू नेपालमा हेर्नु न अब एउटा सेक्टरबाट सबैमा मुभ गर्छ कि अब जस्तै इफ आई हेभ 100 करोड रुपिज वाट आइल डु भन्दाखेरि मैले मार्केट आई क्यान लाइक प्ले विथ द मार्केट के मिलेर सो द्याट इज वाट इज ह्यापनिङ नेपाली स्टकमा फर एक्जाम्पल नेको नि बढ्ने सगरमाथा इन्सुरेन्स नि बढ्ने
ब्रोकरले यो आज यो बढाउनु पर्यो भनेर भन्दै रहेछ अनि एउटा ग्रुपले सबै बढाइदिँदो रहेछ कि किनेर
या सो यस्तो हो अब धारामा पानी आइरहेको छ भने अलिअलि पानी आफूले नि लिने कि अनि एक्जिट गर्ने होइन तपाईँलाई जति आइरहेछ सबै लिन परेन नि त सो गो विथ द ट्रेन्ड के कुनै स्टकले सर्किट हान्यो भने there is high chances that stock is going to go up for certain days के that is also one of the shortcut तपाईँहरूलाई होइन अब्जर्भ गर्नु न मार्केटमा है ओके सो
गर्नु पर्दैन नि हाम्रो असाइनमेन्टको लागि लाइक अलि सिम्पलर वे
होइन फर असाइनमेन्ट वाट यु हेभ टु डु भन्दाखेरि फर असाइनमेन्ट यु हेभ टु इन्क्रिज योर मनी के फर एक्जाम्पल 1000 बाट सुरु गरे नि त्यसलाई अब तपाईँले 1200 बनाइनु भयो 2000 बनाइने भयो कसरी बढाउनुहुन्छ तर 1000 बाट घट्यो भने किन घट्यो रिजन हुनु पर्यो ओभर द पिरियड अफ 1 year के अनि त्यो डेली स्न्यापसटहरू हुनु पर्यो अब कसरी भ्यालिड गर्नुहुन्छ त्यति तपाईँको हाई मार्क्स हुन्छ ओके
या श्योर अन्डरस्टुड थ्यांक यू
also I'll try to give you guidelines कसरी के गर्ने भनेर so that अझै सजिलो हुन्छ त्यो अहिले बिग भइरहेछ नि त्यो वालामा so I have shared you practical questions for L4 यहाँ recent return को slides पनि हाल्दिएको छु so you go through it before MCQ then you will be ready to solve questions है त okay so please be prepared for the test is going to happen before our next class Wednesday भन्दा अगाडि नै हुन्छ Friday हुन्छ होला probably but management will inform you. I'll submit MCQ to them. Okay. So everyone, best of luck for your test. Have a nice day. Have a nice weekend.
Thank you, sir. Have a nice day.
Thank you so much. Bye-bye.